Japan's debt bomb is about to explode and hit the US. And what's happening right now in the world's fourth largest economy is going to trigger a chain reaction that will ripple through global markets and slam into your portfolio, even if you don't own a single Japanese stock. Because Japan just crossed a critical threshold. Their 30-year yield hit levels we haven't seen since 1999. Their debt burden has reached $10 trillion, and the yen is in free fall against the dollar. This isn't just another story about Japan's economic problems. This is different. This is urgent. And by the end of this video, you're going to understand exactly why this matters and where the smart money is rotating right now to protect itself and profit from what's coming. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. If you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. If you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link is in the description below. As always, this is not financial advice. Do your own research. Now let's get into it. Here's what just happened and why it's a bigger deal than most people realize. Japan is sitting on $10 trillion of debt. That's a 260% debt to GDP ratio, the highest in the developed world. To put that in perspective, Japan has 2.6 times more debt than their entire economy produces in 1 year. They're spending 25% of their annual budget just servicing that debt, not building infrastructure, not funding healthcare, just paying interest on past borrowing. For years, this didn't matter because interest rates were near zero. Japan could borrow for free. It's like having a massive credit card with 0% APR forever. But that 0% offer just ended. Japanese bond yields are spiking. And when bond yields rise, the cost of servicing $10 trillion of debt rises too. That's when the math gets scary. But here's where this gets really dangerous for us. Japan holds over $1 trillion in US Treasury bonds. They're the largest foreign holder of American debt. And if Japan needs to sell those bonds to manage their own crisis, that pushes US interest rates higher, which affects everything. Your mortgage, your car loan, stock valuations, corporate borrowing costs, everything. And it's already starting. The Bank of Japan just shifted from dovish to hawkish. They're talking about raising rates for the first time in decades. And that's triggering what's called a carry trade unwind. Let me explain why this matters because it connects directly to what's happening in US markets right now. For years, traders have been borrowing yen at near zero interest rates, then converting that yen into dollars and investing those dollars in US treasuries earning 4 or 5%. That's free money, pure arbitrage, but if Japan raises rates and the US cuts rate, that spread disappears and traders have to unwind those positions. They sell US treasuries, they buy back yen, and that creates a massive liquidity crunch. We saw this happen earlier this year. The yen carry trade unwound violently, markets sold off, volatility spiked, but back then the market was strong. We were in a bull run, so the damage was contained, but now we're in a much more fragile environment. Liquidity is already tight, risk appetite is already weak, and if the carry trade unwinds again while we're dealing with everything else, it could be brutal. Now, here's where this connects to what just happened with the Fed. President Trump officially announced Kevin Warsh as his pick to replace Jerome Powell as the next chairman of the Federal Reserve. And the market's reaction tells you everything. Gold collapsed, silver got demolished, and money started rotating out of panic trades. The KRE ETF, which tracks regional banks, has been quietly building a base. And if you understand what Warsh's appointment actually means, you'll see why this sector could explode higher, because regional banks have three massive tailwinds converging at the same time. Lower short-term rates, a steeper yield curve, and deregulation. All three are happening and all three benefit regional banks disproportionately. Let me explain why this matters. For the past 2 years, regional banks have been in the penalty box. They've been left for dead after Silicon Valley Bank collapsed. after Signature Bank failed, after First Republic went under. The entire sector got painted with the same brush. Investors said these banks are broken, they're over-leveraged, they're sitting on unrealized losses, stay away. And there was some truth to that. Regional banks were holding massive portfolios of long-duration bonds and mortgages that they bought when rates were near zero. Then the Fed hiked rates over 500 basis points in less than 2 years, and those bond portfolios went underwater. Not because the bonds defaulted, but because when rates go up, bond prices go down. Basic math. Here's the thing, those unrealized losses only matter if the banks are forced to sell. And most regional banks weren't forced to sell. They held those bonds to maturity. They managed their liquidity. They survived. And now with Warsh coming in and signaling rate cuts, those unrealized losses start to reverse. Think about it. If the Fed cuts rates from 5.25% down to 4% or 3.5%, those bond portfolios that were underwater suddenly move back towards par. The banks don't have to realize the losses, and their balance sheets start to heal. That's tailwind number one. Tailwind number two is the yield curve. And this is critical. Regional banks make money on the spread between what they pay depositors and what they earn on loans. That's called net interest margin. And for the past 2 years, that margin has been getting crushed because the yield curve was inverted. Short-term rates were higher than long-term rates. So banks were paying depositors 4 or 5% on savings accounts and CDs. They were only earning 4% on their loan portfolios. No margin there, no profit. But Warsh is signaling something different. He wants to cut short-term rates while letting long-term rates stay elevated. That steepens the yield curve, and when the curve steepens, regional banks print money because now they're paying depositors 2 or 3%, but they're earning 5 or 6% on loans. That spread is profit, pure profit, and regional banks are way more sensitive to this than the big money banks because they're more heavily weighted towards traditional lending. They don't have trading desks. They don't have investment banking fees. They live and die by net interest margin. So if Warsh delivers even a modest steepening of the curve, regional banks could see earnings explode higher. And the market isn't pricing that in yet. KRE is still trading near multi-year lows. The stocks are cheap. The sentiment's terrible. And that's exactly when you want to be buying this ETF. Now, let's talk about tailwind number 3, deregulation. Because Warsh is not just talking about cutting rates, he's also talking about rolling back some of the regulations that were imposed after the regional bank crisis. Specifically, he's talking about removing or relaxing the supplementary leverage ratio. Now, this gets technical, but stay with me because it's important. The supplementary leverage ratio restricts how much leverage banks can use. It limits how many assets they can hold relative to their capital. And after Silicon Valley Bank collapsed, regulators tightened these rules even more. They said regional banks need bigger capital buffers, more liquidity, less risk. But these regulations also make it harder for banks to lend because every loan they make requires more capital. So they either raise capital, which dilutes shareholders, or they stop lending, which hurts their business. It's a lose-lose. But if Warsh comes in and relaxes those rules, regional banks can lend more without raising capital. They can grow their balance sheets. They can compete more effectively, and that flows straight to earnings. So deregulation is a massive potential catalyst that almost nobody's talking about. Now let me tie this back to what's happening globally, because there's another angle here that makes the regional bank trade even more compelling, and it has to do with Japan. Stay with me because this connects. Japan's bond market just hit yields we haven't seen since 1999. Their 30-year bond is at all-time highs, and this is happening because the Bank of Japan is shifting from dovish to hawkish. They're talking about raising rates, and that's a huge deal because Japan has kept rates near zero for decades. Why does this matter for US regional banks? Because of the carry trade. For years, traders have been borrowing yen at near zero interest rates, then converting that yen into dollars and investing those dollars in US treasuries or other dollar-denominated assets earning 4 or 5%. That's free money. That's arbitrage. But if Japan raises rates and the US cuts rates, that arbitrage disappears, the spread narrows, and traders have to unwind those positions. They have to sell US treasuries, they have to buy back yen, and that creates a liquidity crunch. We saw this happen earlier this year. The yen carry trade unwound violently. Markets sold off, volatility spiked, but back then the market was strong. We were in a bull market, so the impact was contained. But now we're in a much more fragile environment. Liquidity is already tight, risk appetite is already weak, and if the carry trade unwinds again, it could be worse. So why does this support the regional bank thesis? Because if the carry trade unwinds, that puts downward pressure on long-term US rates. Traders selling treasuries pushes yields higher in the short term, but over the medium term, it forces the Fed to cut rates faster to stabilize markets. And faster rate cuts mean a steeper yield curve, which means higher margins for regional banks. So even the Japan situation, which seems like a risk, actually reinforces the regional bank trade because the end game is the same. The Fed cuts rates, the curve steepens, and regional banks benefit. Now, let me talk about the specific risks because there are always risks. Risk number one, what if we go into a recession? Regional banks are cyclical. In a recession, loan demand drops, defaults rise, earnings get crushed, and the stocks get hammered. So if you're betting on regional banks, you're betting against a deep recession. But here's why I think that risk is manageable. Trump is highly motivated to keep the economy growing. He's got midterms coming. He wants to run for re-election. He's going to do everything possible to stimulate tax cuts, deregulation, spending on infrastructure. All that supports economic activity. And regional banks benefit from economic activity. Risk number two, what if long-term rates spike? If the bond market loses confidence in the Fed, if inflation comes back, if foreign buyers stop buying treasuries, long-term rates could go higher even as the Fed cuts short-term rates. And that would hurt regional banks because their loan portfolios would still be underwater. But again, I think that risk is overstated. Warsh has credibility. The market believes he's serious about controlling inflation. That gives him room to cut rates without triggering a bond market sell-off. And if Japan raises rates, that actually creates demand for US bonds from Japanese investors looking for yield. So the dynamics are supportive. Risk number three, what if more regional banks fail? What if there's another Silicon Valley Bank situation? That would destroy confidence in the sector and KRE would get crushed. But I think that risk is much lower now than it was 2 years ago. Banks have raised capital, they've improved liquidity, regulators are watching closely, and the worst of the unrealized losses are behind us. So yes, there are risks, but I think the risk reward is compelling. Regional banks are priced for disaster, but the fundamentals are improving, and the policy backdrop is turning favorable. Now, let's talk about how to play this. The easiest way is KRE, the Spider S&P Regional Banking ETF. This gives you broad exposure to the sector. You're not betting on any single bank, you're betting on the whole basket. And if the thesis plays out, KRE should move significantly higher. You could also look at individual names if you want more concentration. Banks with strong capital ratios, banks with diversified loan portfolios, banks in growing markets. But for most people, KRE is the better play because it reduces single stock risk. Now, let me talk about timing because this isn't a trade that works overnight. Warsh doesn't take over until May. It will take time for his policies to filter through. Rate cuts don't happen immediately. The curve doesn't steepen in a week. This is a multi-month thesis, but that's actually good. It means we're early. We're not chasing a move that already happened. We're positioning ahead of the catalyst, and the early movers in these rotations are the ones who make the real money. Let me also tie this back to the broader macro picture, because what we're seeing is a fundamental shift in how the market is thinking. For 2 years, everyone was obsessed with hard assets, gold, silver, Bitcoin, real estate, anything that protects against inflation and currency debasement. That was the dominant narrative. But the Warsh appointment signals a different world, a world where the Fed still has credibility, where inflation is under control, where the dollar isn't collapsing. And in that world, cyclical stocks outperform defensive stocks. Banks outperform gold. Growth outperforms preservation. So the rotation we're seeing isn't just about regional banks. It's about a broader shift from fear to growth, from defense to offense, from hard assets to financial assets. And regional banks are at the center of that rotation. Now let me address the Japan situation one more time because it's important. Japan's sitting on $10 trillion of debt. They have a 260% debt to GDP ratio. That's the highest in the developed world. And their bond yields are spiking because the Bank of Japan is shifting policy. This matters because Japan holds over $1 trillion of US treasuries. They're the largest foreign holder of American debt. And if Japan needs to sell those bonds to manage their own crisis, that pushes US yields higher, which is bad for everything: mortgages, stocks, the economy. But here's the interesting part. If Japan sells treasuries and US yields spike, that forces the Fed to intervene. The Fed would have to cut rates faster. They'd have to provide liquidity. They'd have to stabilize markets. And that brings us back to the regional bank thesis. Because Fed intervention means lower rates, and lower rates mean steeper curves, and steeper curves mean higher bank earnings. So even the worst case scenario with Japan ultimately supports the regional bank trade. It just might take a more volatile path to get there. Now, let's talk about what happens if this thesis plays out. If Warsh cuts rates, if the curve steepens, if deregulation happens, regional banks could see earnings growth of 20 to 30% or more. And if earnings grow that much, the stocks don't just go up 10 or 20%, they could double, maybe more. Because right now, regional banks are trading at depressed multiples. They're priced like they're permanently broken. But if the market realizes they're not broken, that they're actually healing, that they're about to enter a golden period of profitability, the re-rating could be massive. And this is where the real money gets made. Not chasing stocks that already doubled, but finding sectors that are hated, that are cheap, that are about to benefit from a policy shift. Regional banks check all those boxes. Let me give you one more angle: demographics. Because there's a reason Japan is struggling, and it's not just debt, it's demographics. Japan's population peaked in 2010. It's been shrinking ever since. By 2050, they could lose 25 million people. That's the population of Texas. And when your population shrinks, your economy shrinks. Tax revenues decline. Debt becomes harder to service. The whole system starts to break. And Japan is the canary in the coal mine. Because China's next, South Korea's next, Europe's next, all facing the same demographic cliff. But the US still has population growth. We still have immigration. Our demographics are way better than Japan's. And that means our banks have a growing market. Regional banks in the US are lending into an expanding economy, not a contracting one. That's a massive structural advantage. So when you buy regional banks, you're not just betting on policy, you're betting on the demographics. You're betting on the US having a better long-term trajectory than Japan or Europe or China. And I think that's a good bet. Now let me wrap this up. The Warsh appointment is a reset. It signals that the Fed is not going to be a political tool, but there will be some discipline, some credibility. And in that environment, regional banks are one of the best risk-reward opportunities in the market. You got three tailwinds: rate cuts, curve steepening, deregulation. You got cheap valuations, you got terrible sentiment, and you've got a policy backdrop that's turning favorable. All of that points to significant upside over the next 6 to 12 months. So if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis, head over to stockscommunity.com, try my Discord for just $25 for 7 days. Plus, if you want market updates I can't share on YouTube, sign up at free.stockscommunity.com. If you find this valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it, because the rotation is happening right now. And the people who understand what's going on are going to position correctly for the next phase of this market.